Creating your own banking system through dividend-paying life insurance. You should have put my money on deposit with the bankers so that when I returned, I would have received it back with interest. Matthew 25:27. Banking. The business of a bank, originally restricted to money changing, and now devoted to taking money on deposit subject to check or draft, loaning money and credit, and any other associated form of general dealing in money or credit. Webster's Third New International Dictionary. The very first principle that must be understood is that you finance everything you buy. You either pay interest to someone else, or you give up interest you could have earned otherwise. The alternate use of money must always be reckoned with. Some call this opportunity cost, but it is amazing how people give lip service to this fact but do not put it into practice in their own financial dealings, the equivalent of thinking that the law of gravity applies to everyone else but them. An excellent article appeared in the September 1993 issue of Fortune magazine entitled The Real Key to Creating Wealth by Sean Tully, in which he describes the concept of economic value added, EVA, developed by Stern Stewart and Company of New York City. Tully says, understanding that while EVA is easily today's leading idea in corporate finance and one of the most talked about in business, it is far from the newest. On the contrary, earning more than the cost of capital is about the oldest idea in enterprise. But just as Greece's glories were forgotten in the Dark Ages, to be rediscovered in the Renaissance, so the idea behind EVA has often been lost in even darker muddles of accounting. Managers and investors who come upon it act as if they had seen a revelation. In summary, before being introduced to EVA, corporations were borrowing capital from banks and paying interest, but they were treating their own capital, equity, as if it had no cost. When they were brought face to face with the error of their ways, and conducted their business with this fact included in the equation, then the profitability increased dramatically. EVA's basic premise is, if you know what's really happening, you'll know what to do. The same concept applies to the infinite banking concept. In creating any product, it all begins with engineering. The automobile you drive started out being lines on a piece of paper. If the production workers don't do what the engineers designed, you won't have an automobile, but they did, and your car rolls off the assembly line. Suppose that I get the next one, and it is identical to yours. Same color, equipment, features, etc. They are identical in every way. Can you safely predict that they will both perform identically during their lifetimes? Of course not. Because you and I know someone that can get 200 or 300,000 miles out of a car with no trouble. But we both know someone that can't get 50,000 miles out of their car before it's worn out. How you drive the car and care for it is far more important than anything else. Keep this in mind as we look further at the life insurance product. The engineers in life insurance are known as actuaries. They are dealing with a field of 10 million selected lives, persons that have been through a screening process, and they are working with a theoretical lifespan of 100 years. Then they turn their information over to the rate makers, who determine what the company is going to have to charge its clients in order to be able to pay the death claims and make the whole system work over a long period of time. Then the whole matter is turned over to the lawyers who make legal and binding contracts that are to be offered to potential buyers through a sales force. The glue that holds this all together is comprised of the administrative folks, executives, and clerics, etc. The contract is unilateral. That is, the company promises to do certain things if you meet the standards of acceptability and make premium payments. Read the contract, and it will tell you very plainly that you are the owner of the contract, not the company. The owner is the most important character in the scene. To make the plan work, the owner must make payments into it, and the company, the hired help, must put the money to work in order to produce the benefits that are promised. Those with the investment responsibility will do so in a number of ways, in financial instruments that are fairly conservative. Example, bonds, mortgages, etc. Look at the investment portfolio of a number of life insurance companies and you will see what I mean. One place that is speculative that some companies do invest in is real estate developments and joint ventures with other private organizations. Some large developments of urban buildings have been entirely financed by a single insurance company. This can often include shopping centers. But upon reading the contract, the policy, you will find it plainly stated that the owner outranks every potential borrower in access to the money that must be lent. And what he can borrow is 100% of his equity in the contract, the amount that the company can lend at any one time. If this is true, which it is, then what this amounts to is absolute control over the investment function of the company as it relates to the owner's policy. In essence, money can be lent to the other places only if the owner of the policy does not exercise his option to use the money and pay interest instead. As a result of the foregoing, there is an ever-increasing pool of money. From time to time, an insured person dies. It doesn't happen very often, but when it does, the company pays the beneficiary from the pool of money, and the costs of doing so is allocated among the policy owners on an equitable basis. The hired help, the administrators, must be paid for their work too. You just can't run a business without hired help. Just try to do it and see what happens. Your competitors that know better will run you out of business. This cost is also prorated among the policy owners too. At the end of the year, the directors that actually run the company call the accountants in and, in essence, ask them, how did we do this year on John Doe's policy in comparison with the assumptions made by the actuaries and the rate makers in designing it? We must digress at this point and remember that an actuary is a kind of engineer, and that all engineers overbuild everything they design. If he doesn't do so, he won't be an engineer for very long. I think about this every time I get into the cockpit of an airplane. I have never seen an instrument panel that does not include an airspeed indicator with a red mark somewhere on the face of it. It is telling you, don't go past this point, or the plane will come apart on you, resulting in a rapid loss of control and imminent death to all occupants, or something to that effect. That is not true. It won't come apart until the airspeed is some 20 to 30% greater than the red mark. The engineers have put a fudge factor into the equation. But if you operate the airplane just beyond the red line on a regular basis, you are putting stresses on the wings, etc., that are cumulative in their effects, and one of these days you're going to reap the rewards of your actions. It won't be a pretty sight. Furthermore, the policy is engineered to become more efficient every year, no matter what happens. That is, if the owner does what is called for in premium paying, loan repayments plus interest, thereon that are at least equal to or better than the general investment portfolio of the company. That is, the cash value is guaranteed to ultimately reach the face amount of the policy by age 100 of the insured. There is an ever-decreasing net amount at risk for the company. Not too many people are familiar with the concept of getting better no matter what. So let's look at the airplane world for help. Imagine that we're going to make a very long flight in a Boeing 747. So we load it with all the fuel that it will hold. This makes it capable of flying about 10,000 miles. By the time we fly 8,000 miles, the airplane will now be able to do things that we would never attempt to take off. This is because we have burned up an enormous quantity of fuel, and the airplane weighs that much less. But the engines are capable of producing as much power as when we took off. Therefore, every mile that we fly, the airplane will get more and more efficient, and you can't do anything about it. It gets better no matter what. In designing the life insurance policy, the rate makers have taken into consideration the advice of the actuaries, and their assumptions are not set in concrete. They include the interest earnings on the premiums paid by policy owners, the death claims expected during a time frame, and the expected cost of administration. Over a long period of time, the actuaries can be pretty accurate, but from time to time, the results can be better or worse than predicted. There are variations in interest earnings, death claims, and expenses of operations, and these factors affect the dividend scale declared for the coming year. You can safely say that the real results will never exactly match the illustration provided at the beginning of the life of the policy. But once a dividend is declared, its value is guaranteed from that point on. It can never lose value in the future, as can the value of securities. It has always been a mystery to me. Why do they call stocks securities when it is possible to lose their value entirely? It all sounds like an oxymoron to me. Maybe it's like Social Security, which has no market value at all. A significant period of lower than expected earnings of interest, or a period of more than expected death claims and or administrative expenses, can result in a downer for the company. When this happens in a regular corporation, it is the function of the stockholders to take up the slack. But in this case, the rate makers are reminded that we don't have any stockholders. So the rate makers are cautioned by the actuaries that if we calculate that it would require $1 per year for a given plan, don't collect $1, collect $1.10. This extra 10 cents is the capital that makes the whole system viable. Now, back to our scene on John Doe's policy. He has had it for a few years, and the directors have asked the accountants, how did we do on John Doe's policy this year? The accountants report that they had collected $1.10, but after calculating all the aforementioned factors, they found that it took only 80 cents to deliver that promised death benefit in the future. This means the directors can make a decision with 30 cents. If they are halfway smart, and most of them are, they will take into consideration that they need to put a part of this into a contingency fund to prepare for unexpected future risks. So they put 0.025 into the contingency fund and distribute 0.275 and call it a dividend. Most people have the impression that this is a taxable event. This is not so. Remember, the income tax has only been with us since 1913. The U.S. got along very well without it prior to that time. There were surpluses in the budget, and life insurance has been around for over 200 years. The word dividend was used by the insurance industry to describe this dispersal, and it stuck with us. But the correct classification is a return of premium or a return of capital, which is not a taxable event in IRS terminology. If the owner uses the dividend to purchase additional paid-up insurance, no cost for acquisition, sales commissions, etc., the result is an ever-increasing tax-deferred accumulation of cash values that support an ever-increasing death benefit. And there are no government bureaucrats looking over your shoulder telling you what you can and can't do. The result is limited only by the imagination of the policy owner. By the way, these dividends can get pretty significant over a long period of time. I bought a policy from a major insurance company in 1959, and the annual dividend is over 10 times the annual premium now. They would have been much larger had I not used the annual dividend to reduce premiums for the first 15 years. These things are just not adequately explained by life insurance sales folks because of the limited understanding of their home office folks that teach them. A pity. So far, this is pretty simple stuff. Now for the complicated part. The life insurance salesperson calls on my all-American young man referred to earlier in the book, the one making $28,500 after taxes and is 29 years old, and he urges him to consider how much the world is going to miss you in the case of your untimely death. So he calculates his human life value by asking how much he expects to earn per year as an average and multiplies that by the number of years that he expects to work. Assuming he lives that long, assuming that he will get pay raises from time to time, it is reasonable that his average annual income to be something like $38,000 times 36 years until he turns 65, which will produce $1,368,000 in income. The insurance agent points out that he will use up something like 40% of this income stream to support his own needs. This means that $820,800 in income for his family and the charities he holds dear will vanish if he happens to die in the near future. To arrive at a principal sum, the capital that would be required to produce that income stream, this figure must be discounted at a nominal rate of interest. The agent says, so if we were to have to buy a machine that would produce that income to your family, we would have to pay about $400,000 cash for the machine now. That's how valuable you are to them and your charities. Mr. Doe, if you own such a machine and it was subject to a sudden loss by some kind, would you insure it? Mr. Doe says, by all means. The agent asks, how much would you insure it for? Why, $400,000, of course. To which the agent responds, now that we have that established, let me show you how little you'll have to pay my company to satisfy that need. My word, if you will take an honest look at what this young man is now doing, paying over 35% of every dollar of after-tax income to interest alone, it should be obvious that his need for finance is much greater than his need for life insurance protection. If he would solve for the need for finance through dividend-paying life insurance, he would automatically have much more life insurance and recover all the interest he is now paying to someone else. But this almost never occurs because of the mental block implanted by financial geniuses that life insurance is a poor place to store money. What a limited outlook of just what is going on in the banking world. Again, I remind you, if you know what's really happening, you'll know what to do. And so the young man puts $50 per month into life insurance premiums and feels that he is insurance poor. He is worth more dead than alive, etc. Then he goes down to the dealer and buys an automobile, paying for it with a loan from a bank or finance company. Remember that there is only one pool of money out there in the world. The fact that any number of organizations or individuals are managing a portion of the pool is incidental. But it can be even more specific when it comes to automobile loans. I have never seen a monthly list of investments from a dozen of major life insurance companies that did not include finance companies as a place where they have loaned blocks of money. The finance company simply buys blocks of money, adds a fee to it, and loans it to customers that buy cars. So this man pays $260 per month for a minimum of 48 months for his $10,550 car loan. He does this throughout life because that's the way all his peers are doing it. If he would take time out and stand back far enough to get some perspective, he might notice that he is paying $50 per month into a pool of money, the life insurance policy, and paying $260 per month to an intermediary, the finance company that deducts a fee and lives well off the activity, which passes the residual sum back to the same pool of money. Furthermore, he complains about the premium he pays but thinks nothing of the much larger amount he pays the automobile finance company. Strange, isn't it? In the above example, he is paying a total of $310 to the pool, $50 directly and $260 indirectly. If he could muster up the courage to pay $310 directly to the life insurance company in the form of premiums for around 4 years, he could now make a policy loan and pay cash for the automobile. Here comes the important part again, so pay close attention. The insurance agent now needs to make him vividly aware that he must pay the loan back at an interest rate that is at least equivalent to the going interest rate of an automobile finance company, not what the policy calls for. In this case, it should be at least $260 per month. If the policyholder does this, then he will effectively make what the finance company would otherwise make and do it all on a tax-free basis. If the agent is really good and understands the principles of banking, he will encourage the policyholder to pay $275 per month because the extra dollars will go to his policy to increase the capital that can be lent to other parties. If the policyholder objects that it's my own money and I'm not going to pay any interest at all, or maybe I'm only going to pay 2.9% interest as seen in television commercials, then the agent must remind him of the grocery store at the beginning of this book and explain it to him one more time. If he still doesn't understand, then the agent needs to have him revisit the story of the failure of the First National Bank in Midland, Texas. If he still doesn't understand, the agent needs to resign from working with him because he is not teachable or is a thief. Neither of these characters is a desirable business associate. You have now had an explanation of all the essential principles of banking through the use of dividend-paying life insurance, but to understand the infinite qualities of the infinite banking concept, it requires a deeper look. In the above example of the car financing, the capitalization needs to be somewhat greater than just 4 years. Many college business professors estimate that corporations expect it to take at least 7 years to get back a profit on a new investment. This is an understatement in certain undertakings. So why not capitalize each policy purchased for at least 7 years, to the point where dividends will pay all the remaining premiums on the policy? This will be explained in detail later on in the book. Would you have much of a grocery business if you were the only customer? You must build it to the point where you accommodate the needs of others in order to prosper. The same principle applies to banking. Furthermore, I am not describing one life insurance policy. This is a system of policies. Have you not noticed that when a grocery store becomes successful in one location, then it tends to establish another store in another location? Have you not noticed that banks have branch offices? There must be a reason for their behavior. Then why not expand your own potential by buying all the life insurance on yourself that the companies will issue, and then on all the persons in which you have insurable interest? At present, does not all your income go through the books of some banking institution? Don't the banks lend out the deposits of customers? All they do is capitalize the bank, capital stock, to make it a safe place for customers to deposit money and then lend out the money left on deposit. If they don't lend money, they will go out of business. It will take the average person at least 20 to 25 years to build a banking system through a life insurance to accommodate all his own needs for finance, his autos, house, etc. But once such a system is established, it can be passed on to future generations as long as they can be taught how the system works and suppress their baser instincts to go out the back door of the grocery store, or in a word that is descriptive, steal.